In this video, we will explain what revenue deficit is, how it's calculated, its impact on the economy, the reasons behind it, and the steps that can be taken to reduce it. We have already talked about India's first budget, why the union budget is important, its purpose, and its constitutional requirement. We have also covered topics like the revenue and capital budgets, the contingency fund, the consolidated fund of India, public account of India, and fiscal deficit. Don't forget to check out the other videos in this playlist for more helpful insights. In simple terms, a revenue deficit occurs when the government's income, revenue receipts, is less than its day-to-day expenses, revenue expenditure. To better understand revenue deficit, let's first look at how the government earns money, known as revenue receipts, with some simple examples. Revenue receipts are the money the government earns, mostly from taxes. These include income tax, which people and businesses pay on their earnings, GST, goods and services tax, which is added to the price of goods and services, and customs duty, which is a tax on goods imported into or exported out of the country. Revenue receipts also include money the government earns from public sector companies like ONGC, State Bank of India, SBI, Coal India, and many other public sector companies through their dividends and profits. It also collects money from fines, penalties, and other sources. Now that we have seen some simple examples of how the government earns money, called revenue receipts, let's look at how the government spends it on day-to-day activities, known as revenue expenditure, with some easy examples. Revenue expenditure is the money the government spends on the country's daily needs. This includes paying salaries to employees, pensions, subsidies for essential food items like wheat, rice, and other essential food items, and welfare programs like free healthcare and education. When the government spends more money than it earns from its regular operations, it creates a gap called the revenue deficit. For example, if the government earns 100 crore rupees from taxes and other sources but spends 200 crore rupees on subsidies, salaries, free healthcare, free education, and other daily operations, the revenue deficit would be 100 crore rupees. Revenue deficit calculation formula is revenue expenditure minus revenue receipts. For example, if the government's revenue expenditure is 200 crore rupees and its revenue receipts is 100 crore rupees, the revenue deficit would be 100 crore rupees. This 100 crore rupees is the gap the government needs to fill, usually by borrowing money, raising taxes, or finding other ways to generate income. This borrowing can happen through methods like issuing government bonds or taking loans from international organizations such as the World Bank, IMF, and similar institutions. Now, let's look at how the revenue deficit impacts the country's economy. When the revenue deficit is too high, foreign investors and companies may hesitate to invest in the country as it signals financial instability. The country's credit rating could also be downgraded, making it harder and more expensive to borrow money. In extreme cases, if the government's debt becomes too large, it may struggle to repay individuals who have invested in savings schemes like government bonds. This is why it's crucial to manage the revenue deficit carefully, maintaining a balance between economic growth and financial stability. Now, let's look at a few key reasons behind a revenue deficit. One big reason for revenue deficit is low tax collection. This can happen because of poor tax collection systems, people avoiding taxes, or an economic slowdown that reduces income from taxes, like income tax and GST. Another reason for revenue deficit is the high cost of subsidies on essentials like food, fertilizers, and fuel, such as LPG or kerosene. These subsidies are important to support people in need, but add a lot to government spending. Revenue deficit is also caused by the high expenses on salaries and pensions for government employees, as well as welfare programs like healthcare, education, and job schemes, which often exceed the government's earnings. Now, let's explore the steps that can be taken to reduce the revenue deficit. To reduce the revenue deficit, the government can adopt several strategies. One key approach is increasing revenue by improving tax collection systems, introducing new taxes, such as higher GST on luxury goods, and boosting non-tax revenue through dividends, fees, and royalties from public sector enterprises. Another way to reduce the revenue deficit is by minimizing unnecessary expenses, such as gradually reducing subsidies on fuel, electricity, fertilizers, and optimizing welfare programs like healthcare and education to eliminate inefficiencies. The government can also take other steps by consulting with financial experts, economists, and specialists in relevant areas. Now that we've covered the basics of revenue deficit, I'll keep adding more videos to explain important budget terms and concepts in a simple way. Don't forget to check out the other videos in this playlist for more easy to understand explanations.